Hi there, I'm Paul Wan with the Wan Group, and this is our dog Manning. And I wanted to do a quick video today based on a topic that came up during a recent real estate investor webinar. There's been a lot of confusion in the media, social media, and that type of a thing, with people talking about how they really believe that the real estate market is in trouble, and they're saying that it's analogous to 2008. A lot of people trying to draw parallels to that. And what I'd like to do is just give you our point of view on it. So the thing that I find that's very interesting about this is that when COVID started, the Federal Reserve started using their open market operations, and one of their ways to impact the economy, in this case they were trying to spur the economy on to keep it healthy during the COVID years, was to dramatically reduce interest rates in the form of the federal government subsidizing interest rates. So we saw interest rates under 3% for some time. Now that's not a naturally occurring thing. People can't loan money for mortgages at less than the cost of inflation and make any money doing it. That should be pretty obvious, I would think. So what happened is the federal government subsidized interest rates to spur the economy on during COVID, and they did a great job. We saw the real estate markets in many major metropolitan areas appreciating at 20 to 30% a year in 2021 and some of the time surrounding that. Now, the issue that we get down to is it seems to make logical sense. They lower the interest rate to spur the economy. But then what happened? What happened is that because of all that cheap money in the system, we saw inflation start to crop up. And people got really stressed out about inflation. And not just real estate, it was very difficult for people to buy real estate because there's 40, 50 people making an offer on a property. And we saw properties go as high as 25 to 40% over the asking price. It was just made no sense. But it was that cheap money that was spurring that on. We also saw a lot of our costs in our society, just our daily living expenses going up, because that cheap money was fueling the economy and causing that inflation. So what happened is the Federal Reserve then started to raise interest rates to bring inflation into check. And all of these things that we're seeing in social media seem to act like this has nothing to do with a correlation between protecting the economy and keeping things appreciating at a safe and comfortable pace. What we really see that happen is the Federal Reserve lowered interest rates to spur the economy during COVID, and then they raised interest rates to tame inflation when inflation got a little too high. And they're doing a great job of that. The inflation numbers are coming down. But we're seeing articles that are saying, hey, real estate's headed for a 2008 type event. I just don't see that. In fact, I saw an article that the headline made it very, very clear they were trying to suggest that the real estate market values were tanking, when in fact, what the article actually said is in the markets they were looking at, the year-over-year appreciation was still between 11 and 14% from the previous year. That means the market's still going up between 11 and 14%, which is down from 25 or 30%, and getting closer to that sustainable long-term average in most major metropolitan areas of plus or minus 9% per year on average. So what I'd really like to encourage people to consider is that interest rates didn't raise arbitrarily. Interest rates didn't raise because it was an accident. They were done to control inflation. You can't have everything at the same time. You can't have cheap or free money and not have inflation. You can't have low interest rates and not have inflation. And so now we're getting back to market interest rates, which typically over time, you'll see that 6 to 8% is kind of in the wheelhouse of what tends to be normal as far as lenders being able to make a profit. So what I really want to encourage people to realize is that inventory for rental properties is at an all-time low. In many areas across the country, we're seeing that real estate investors are buying 17 to 20% of all of the real estate in the market. In fact, in the Dallas metro area, real estate investors are buying 30% of everything in the market. So what you'll see is that Wall Street and investors are coming into the real estate market to take advantage of safer and less volatile values that real estate represent relative to things like the stock and the bond market. So anyhow, I hope this was helpful. We have a number of videos on different topics that we hope you'll find helpful and informative. And we also have a regular investor webinar that we do. So if you haven't seen that before, please feel free to attend or contact us to set an appointment to talk about your personal investing goals, and we'll talk about how we can help you do that more efficiently and profitably. So this is Paul Wan with the Wan Group at RE/MAX and Manning, and it was great talking to you today, and hope you have a wonderful day.